Hey guys, my name is Max Convexity. I appreciate you all for being here. My channel's name is The Covered Caller. I strive to be the number one source for option strategy-based ETF information. I'm increasingly focusing on the liquid alternative ETFs as well as the option-based ETFs. So I'm an ex-financial planner with 37 years of option trading experience. I have a totally free Discord, and we debate the relative merits of these high-yield ETFs and the option strategies that power these high-yield ETFs all day long. Today, I'm going to talk about the business side of liquid alts and covered call ETFs. I normally talk exclusively about yield max defiance, curve, and round hill. Today, I'm going to branch out and talk about some new names. All right, this year's been one for the record books. We've surpassed 4,000 total ETFs out there in the world. That's up 62% just in 1 year. So that amounts it's up 62%, but in numbers, that's 1,500 new ETFs just last year. 1,487 of those were covered call-based ETFs. Just kidding, but it does seem like these option-based ETFs are everywhere. This rapid expansion was driven by just a crazy, robust equity market and a surge in investor interest. Investors pumped about $1 trillion into all ETFs, moving capital away from money markets and into things like the SPY. It wasn't just the covered call funds. And also, speaking of the SPY, it was up more than 26% 2 years in a row. Now, there was only 200 funds out of the 4,000 total funds. We only had 200 closures. So that's about a 3.8 ratio. So that's pretty good. You want a high number, or if you're in the ETF business, they want a high number. You want lots of opens and very few closes, right? All right. It's also been a big year for the liquid alt. So a liquid alt refers to a liquid alternative investment, which is an alternative strategy offered in a liquid and accessible format, usually an exchange traded fund when we're talking about it. It could be other things, but these products aim to provide exposure to a different asset class or a different strategy, or sometimes both, than were traditionally available to a retail investor. Traditionally, these were the types of things that were limited to hedge funds and private equity. A covered call ETF is kind of a liquid alt light or liquid alt adjacent. Covered call funds and other alts also aim to diversify a portfolio, and it's by incorporating the non-traditional strategies like the callers and the covered call spreads. It gives those strategies a new twist. These are not your father's ETFs. This is not your father's covered call strategy. All right, let's talk issuers. As far as ETF issuers, when we're talking alts, alternatives, and covered call ETFs for that matter, it's about title, and it's all about title. You might remember when I had Mike Venuto, the co-founder of Title, on my station back in December to talk about the new Dorsey Wright rollout and the new Fire branded ETFs. Well, Mike's a giant at the ETF business. I always enjoy speaking with him. He was on Retire on Dividends channel last night. I highly recommend you watching him on that show. It was a good show. He broke a lot of news last night. Title has more alts than any other issuer. He knows about this business. Biggest news he broke to me is he says there's funds coming out that will pay a yield, but will have protected downside. I think that would be huge. GPTY has semi-protected downside right now, but I would be anxious to see one of these high-yielding funds that has 100% protected downside. We'll see if they can do that. I think that would be interesting. Mike also said that Jay shut down the fund TRES too soon. If you're a longtime watcher of my channel, we used to talk about TRES all the time. But I think they need to bring out another fund like TRES, but maybe based on the NASDAQ this time instead of based on bonds, and it would have been more of a success. All right, so right here, this is the company that is the parent company behind Title, and this is their total assets under management for the whole operation. They manage $21 billion. I mean, that's incredible. So they managed 21 billion, but of that 21 billion, just in December of 24, they brought in 13.69 billion. And you can see they had inflows all year long, especially around the time of the Dorsey Wright rollout. Okay, so now here is just YieldMax. Now, YieldMax is a subset of that parent company that I just showed you. So of that 13 million, YieldMax, or billion, YieldMax was responsible for 9 billion of it. Wow, great job, YieldMax. Then we have Neos down here, 3.2 billion. We talk about Neos. We have Granite Shares. Will Rind has been on the show before, but they had 1 month net inflows of nearly 7 billion. Curve, 32 million. And I think I slid by Defiance by mistake. And Defiance had 1 month net inflows of nearly 3 billion. And you can see Defiance raised a lot of money right around the end of the year. Curve had a smaller amount, but Curve's a little bit smaller company, but it was a big year for everyone. Even Curve had big inflows at the end of the year. So, and that's the way it works lots of times, but that's the way, that's what the funds hope for. They better hope they get big inflows. That's how they stay in business. All right, so now I want to talk about some individual tickers in the liquid alt business. The first one I want to talk about is XOVR. Now, this one is it's an ETF, but it gives you access to the venture capital business. So this has pre-public shares of SpaceX in it, and supposedly you're paying the correct price. It's not a markup. If you can believe their literature, that's what it says. But that's something pretty special. But before this ETF came out, you wouldn't have had any way that I know of, without having a lot of money or a lot of connections, or really a lot of both, to have pre-public stock in one of Elon's companies or something that I can't think of. Anyway, so I think if they could keep doing this, and especially if they could get maybe stock of 10 different companies in there at once, maybe we've had SpaceX and 9 other Silicon Valley companies, and have a little diversification. But anyway, this is interesting. They are diversified. They do have some other tech funds in this as well. Just go check it out yourself if you're interested in it. I'm not that interested in venture capital, but because I don't know that much about it. But boy, if I was, this would be one way to look at it. One way to do it. All right, now let's talk about some other liquid alts. One of the oldest ones is something called KMLM. That's called KFA Mountain Lucas Managed Futures Index Strategy. So this ETF is trying to give you a positive absolute return by utilizing a managed future strategy. So basically, what managed future strategies do is they use some element of trend following, and they try to give you some element of exposure to commodities. And futures don't have to be commodities, but oftentimes they are things like lumber or wheat, but can also give you exposure to financial commodities, which would be like a bond or something. Or so that'd be like in this case, they're saying they're doing liquid exchange traded futures across various asset classes. But anyway, they try to give you some exposure to the trend of the market. And the idea is this can potentially offset some of the effects of inflation. So that's one reason people like that fund. Another fund that's kind of like that people talk about sometimes is CTA, similar type deal. There's also XVOL and SVOL that are hedge fund type strategies. There's also something called Chaos, which I really like. I need to make a full video about. It's a combination of 3 option strategies. It's very complicated, very sophisticated, and very interesting. And then there's something called FTLS. That's the first trust long short. That's not a bad fund. That's an equity fund that has some long. They try to buy some good stocks and sell short some bad stocks, hold them both in a portfolio at the same time. And, that's kind of basically a similar strategy to what Jim Simons used over at Renaissance Capital. And he did pretty well. I mean, it's that similar strategy. So even Trump has an alt now. Okay. There's a company called Rex Osprey. They filed for an ETF based on the Trump meme coin. So let's get in the thick of it here. Let's start with Trump. Let's start with Mr. Trump here, President Trump. Okay, so this is the filings for this Rex Osprey. Now I've heard of Osprey before, and of course Rex, I've heard of them, but I mean, so they filed for like 7 ETFs. They have the Trump ETF, the Ethereum, Bitcoin, Solana, Ripple. Then they have one called the Bonk. I don't know of that meme. I know about Doge, but I'm just not aware of what Bonk is. Someone knows, I'm sure you guys will tell me in the comments. But anyway, the main one we're interested in is the Trump one, just because it's in the news. But from what I can tell, and I've read this, I don't want to bore you guys with the details, but they're going to invest in the Trump coin. And that's all. I figured they might invest in something else too, but it appears to be they're going to invest in the Trump coin, and they're also going to invest in derivatives related to the Trump coin. So maybe they're going to use swaps to get exposure to the Trump coin price movement or something. But in any event, I don't know. Not for me, but, it might be for one of you guys. It even says down here, it explains right here, the fund seeks to gain exposure to the reference asset, which is Trump coin, in whole or in part through an investment in a subsidiary organized in the Cayman Islands called Rex Osprey, the Trump Cayman portfolio, subsidiary. So they in another fund is doing this too. There's something about the Cayman Islands. Probably it shields the fund companies from some kind of liability or something. I don't know, but if any of you guys know, you let me know as well. But there's something about these funds in the Caymans. This one has all kinds of risks. I mean, heck, it's based on the Trump coin. I mean, but it could also do great. I mean, it could short squeeze. Who knows? I mean, it just depends on when you buy it and when you sell it, I guess. I mean, not investment advice, but let's say you were a bull on maybe Solana or Ripple or something. Maybe this is a way that you could get exposure to. This one's for Ripple right here. And I'm sure it's just going to say the same stuff that it is. They have a subsidiary and they buy Ripple in the Cayman Islands and give you exposure to it. So very interesting. Okay. So that's somewhat interesting to me. What is more interesting to me is this right here from Colomos. And this is where you can get exposure to Bitcoin, but with 100% downside, no downside, danger. It can't go down. This is a product, and the product itself, if you hold it for a year, you can't lose money on the NAV of the product because they have it collared and it's locked out. Any kind of downside's locked out. Now that's the good news. Is the bad news is you only get 11% upside. So you have to trade in part of your upside, but I mean, you can invest in Bitcoin, with 11% possible upside. It has to go up at least 11% or you won't even get that. But say Bitcoin's up 50%, then you're going to be up 11.5. You're going to get all that, upside. And if Bitcoin's down 50%, you're going to be down 0. Anyway, you might want to check out this product if something like that interests you. That's a CBOJ. These guys also, and that doesn't really interest me too much, but this does. This is they have the same concept where they have a structured protection on the S&P 500, where they make it where you can't lose on the S&P 500 over the course of a year. Now, yeah, this one is interesting to me for sure. And they issue these every month. Now, in every month they have a different cap. The cap depends on the prices of puts and the prices of calls, because this fund sells a call and buys a put or some combination like that. But anyway, when volatility is low and cheap, they can have a bigger cap. But when volatility is expensive, they get a smaller cap. Well, anyway, you can see here how their caps changed over the months. Here it was like 9 months ago, the cap was 9. Then the cap came down, and then 4 months ago, the cap was only 6.67. That's the smallest one I've seen, but you don't have to buy that month. You can just invest in months where the cap meets your goals. But anyway, this is real interesting as well. It's Columnos. Oh, this is a better table. This shows you the initial cap and the current cap, current downside before protection. All right. Well, in any event, that to me is interesting. Those are definitely liquid alts, hedge fund type strategies. Okay, this one is probably the most interesting of all of them. We'll finish on this one. This is a new fund that I haven't heard about before, and it's also based on an index. It's an index and a fund, and I haven't heard of either of them before I started doing research for this video, a few days ago. It's called Gamma Road U.S. Equity Strategy. And it's, like I say, it's based on an index, but the idea of the index is they try to give you a systematic edge where you have a rules-based system in allocating. So what they follow 3 key risk metrics. One of them is the economic strength. Somehow they look, what they do is they look at a ratio of gold prices to commodity prices, I think is what that implies. Number 2 is they look at consumer confidence, and they probably do a trend or a moving average or something. The number 3 input is the price direction of the SPY itself. In other words, the SPY going up or is it going down, the momentum factor. Based on those 3 factors, they give you an allocation to the SPY, and it's mechanical. Well, this is something like a hedge fund would do. Now, right here, the fund's only been around a couple months. The index has been around a year. So this is going back a year and look at their index. Now, this is all based on hindsight. They could have optimized the index and probably did for this past time period or something. I don't know. But anyway, here's the idea of how it's supposed to work. So they have those 3 factors. When they all 3 line up, and it's the market's trending up and those other 2 factors are pointing up, then they're 125% invested. So how they do that is they only use 3 funds, 3 ETFs in this portfolio, but they use a leveraged SPY product and just the SPY. Okay. But then whenever just 2 out of the 3 indicators are bullish, they go down to 67%. And that's kind of this green, this aqua color here. Okay. Now that's the next level of conservative. All right. And then whenever only 1 out of 3 is positive, 1 out of the 3 factors is positive, they go to only 33% invested. So the way they do that is, I saw how they did this last night. Well, I guess it's just all they do is they just go 33% SPY. That's what it is. But then there's another level below that where everything's bad and they go 0%. And so then they're all in T-bills. I was trying to think when they do the 33% SPY, are they SPY in T-bills or they just SPY? But I think they just cut back on the SPY. But so you can see historically, last December, January, February, the first quarter of 2024 was a face ripper. The last quarter of 2023, that's when I first started my channel, and the market just ripped. Well, the strategy was 100% bullish there. They were on bullish plus leverage, so that's good. But then like in March and in April, they cut back to only 67% bullish. And sure enough, the market pulled back into April. Well, anyway, they went at 67% bullish the rest of the summer. But then on into mid-July, about the time we all started noticing volatility started getting elevated. This thing may look at some same stuff that my stuff factors. But anyway, about mid-July, things started setting off warning bells. And sure enough, the fund went down to only 33% invested. So and that actually cost them money because the market did great. But still, it looked like a risky time in the market. In hindsight, it cost them money. In hindsight, they would have been fine to stay leveraged, but you don't know that at the time. But in any event, as soon as the election was over, then they went back to 67% invested. And then by around the first of the year, they're full invested now. They're fully bullish, just like they were the last quarter. So who knows how accurate their system is. They have a back test that beats the S&P, but it's easy to make a back test that beats the S&P, it's hard to do it in real time. But it's definitely an interesting idea. Gamma Road, the symbol is GMMA. I mean, they haven't been out that long, but let's compare it. GMMA let's compare it to triple QT. All right. Well, triple QT's spanking it. And triple QT paid 10 times the dividend. The other one, GMMA, is not a yield fund. It's not a yield fund. It's just an equity allocation strategy. But when this strategy is running right, the idea is they should be able to get you long when it's a good time to get long, and be able to get you protective, and be able to get you in a more protected stance when need be. So, very interesting. So that to me is definitely a liquid alt. All right, guys. So these are all liquid alts. I think all of them can have a potential place in the portfolio. Here's a 1-year chart of a bunch of liquid alts. This orange line up at the top is CLSE. That's a long short equity. That was up 35% last year. That's killing it. XVOL from Accruance Capital was up 23%. That's down here in blue. That also had a real good year. This Chaos, you may not notice it because it's just up 5, but look how steady this thing is. Chaos is an interesting fund. I also don't know if you guys can see that. Chaos was up in the August pullback, as was XVOL. Most of the other stuff was down. And that's because XVOL and Chaos have built-in hedges. They have some pretty aggressive protection. So that's one reason I talk about those funds so much. But really, that's out of all the stuff Mike said last night, really he basically said everything's coming out over the next year. There's going to be iron condors. He said every type of strategy is going to be out. So, I mean, that alone is interesting. But then when he said that he said they're coming out with ones that will have protected downside and still yield, that is super, super, super interesting to me. Like I say, I would love to see them take the highest yielding one they have and try to protect 100% of the downside. It'd be expensive. The hedge costs money, but those ones that yield so much, I think they might be able to pay for a pretty decent hedge. We'll see. We'll see. I talked with Jay here next month, and you can bet I'll be asking Jay Pestrichelli about it as well. All right, guys. Well, I appreciate you all for being here, and I hope you have a great day. Take care.